next panel is going to explore how contracting trends are changing due to the scale of AI gigafactories. Contract terms are varying to spread out the risk between the tenant and the operator, and early termination rights, early termination fees, and supply chain failures are now balanced towards the tenant. So please join me in welcoming our panel to the stage, who are going to be discussing a spotlight on contracting trends.
Thank you for joining us, everybody. I'm not checking email. This is where my questions are. I'm Kamal Hawa, Kirkland & Ellis. We're an industry-leading law firm in the digital infrastructure space globally. And I will turn it over to the audience, to the panelists, to introduce themselves one by one. Atif?
Atif Ansar. I wear two hats. I'm an academic at University of Oxford, working on mega projects, and I'm also a founder of an AI company called Foresight that helps recover delays on big data center projects.
I'm David Gentile, Chief Customer and Commercial Officer with NextDC. We're an operator out of Australia. We have about 700 megawatts in our portfolio.
Hi everyone, I'm Alana Hasek. I'm European General Counsel at CyrusOne. We are a US headquarters data center developer and operator.
Hi, I'm Cabral Abel. This is very loud. I am an Associate General Counsel at Microsoft in our Infrastructure Legal Affairs team. My team is a global team that looks after our land acquisitions, permitting, our leasing, our operating of our data centers, our construction, and networking, so pretty large scope.
Hi, I'm Alon Gavrilov. I'm the VP of Infrastructure Strategy at Together AI. We're a inference-focused AI infrastructure platform, allowing companies to run their AI-native applications, reinforcement learning, training, things like that. And I'm responsible for the infrastructure build-out, both on our own data centers and third-party cloud.
Well, great. Before I jump into the questions, one quick disclaimer for Cabral. Her views are her own and do not necessarily reflect the views of Microsoft. And she will let us know if I ask a question that is not fieldable. Okay, so let's jump right into it. I'll start with a long lead-in question, and it's fundamentally going to be the question that drives this distinguished panel, which I'm quite excited about because it's more of a deep dive into some of the issues around contracting and financing and how we get these deals over the finish line. But I'm often fond of saying that, 4 or 5 years ago, 3, 4, 5 years ago, globally in the industry, we were doing 20, 30 megawatt deals, important deals to the industry, but $10 million of capex per megawatt. You were talking about a $200 or $300 million investment, which is not insignificant, but was manageable. Manageable power risk was manageable, financing risk manageable. Now we're doing gigawatt campuses, which fundamentally change the risk profile of these deals in every way. So this panel is going to be discussing how that dramatic proliferation in size and scale of projects is reflecting itself on the ground, in contracts and otherwise. So let me start by, I'll start with Alana and say, listen, let's talk about the most critical input into data centers, the power input. Listen, everybody knows there's global power shortages, unavailability. There's simply no capacity in existence to accommodate a gigawatt campus. It needs to be constructed contemporaneously by third parties that are outside of the control of the parties to the project. Oftentimes, electric utilities. How are data center operators managing that risk, knowing that you have to deliver in a timely way against global power availability shortages?
Thanks, Kamal. I think the starting point for us is the diligence at the front end. I think historically people found land and then they thought about the power afterwards. And you just can't do that anymore. And we are starting our strategy with thinking about power first. Where are the markets that we can find clear access and route to power with a predictable timeline where possible, which obviously is pretty tricky in the most constrained markets that exist. But fundamentally, a lot of the way that we're mitigating that is at the front end through the diligence process, not only understanding where we think power is available, secure, and green, but also thinking about the regulatory landscape around the power availability. So, okay, it's great having a clear line of sight to power at good pricing that we think will appeal to our customer base. But if you can lose that power with a use it or lose it mechanism or regulatory change that potentially means that because you haven't progressed your site within a certain timeline that there'll be clawback provisions, then it's all pretty much for nothing. So from our perspective, one of the key things is really focusing on the diligence at the front end on site selection with a power strategy.
Great, and I will go then to, actually for this one I'm going to go to David next and say, David, how is power risk being allocated in your customer contracts?
Yeah, I agree with the fact that if you don't have the power sorted out pretty early, it's going to be a disaster. So every customer is looking at power differently in the contracts. We're probably a little bit more mature, where our larger customers dictate that if you don't have clarity on your power all the way through to the end, you're probably not going to get your contract done, which is a little different to perhaps some of the emerging opportunities where there's a little bit more risk-taking in the contract, and there'll be a shared risk to say we have a pathway contractually, but we're not 100% sure what that timeline looks like. So I still think that perhaps when the stakes were smaller, but they were still relatively large, 10, 20, 50 megawatts, it was easier to have line of sight into your contracts, and the penalties were probably less onerous. When you start talking about hundreds, if not single gigawatt, the penalties are pretty significant, so you have to do your due diligence and wrap it up in your contract on both sides.
And as sorry for looking to the side. These lights are glaring. It's hard. It's very difficult to look straight ahead. So we'll all be angling our gaze a little bit to the side.
We could save some power.
Yeah. So, Cabral, obviously, speed to delivery is first, second, third, fourth, and fifth the most important. From Microsoft's perspective, and probably the single biggest gating item is power. How do you view the allocation of risk of power risk in particular in terms of delivery timing?
Yeah, so especially if we're working with an operator, I think it's kind of in line what David, you were just talking about, that we want to make sure that we've done our due diligence and that the operator has done their due diligence before we're going to sign up to the contract. And if we do, Microsoft has as part of its contracts SLAs that include power and that include you have to be ready for service with your power. And so, that's just kind of super important for us before we'll proceed with a contract.
And I'd be interested, since power is so central, and Ilan, your take on this, as ultimately as an off-taker, you're dependent on the hyperscaler or whoever you're receiving service from getting timely delivery and power up, and which in turn is dependent on the data center operator timely delivering and getting power up and running. How are you able to manage delivery risk on your end, knowing that upstream from you there's maybe 1, 2, 3 inputs or players that are relevant to your being able to deliver service?
Yeah, so it depends if we're securing compute resources through a neocloud or securing data center space. But in both cases, it's all about doing the diligence, as the other panelists mentioned. So if it's a data center operator, We, of course, want to vet. We want to see, do they have an ESA? Do they have a PPA? Have they, if it's a behind-the-meter solution, have they secured the right permit? It's really doing a strong level of diligence to enable trust that they can execute. On the bare metal NeoCloud side, when we're securing compute through there, it's some of the same diligence. If they do not, we like to work with people who sort of are strong on the power side, data center operators that came from a background where they're able to secure low-cost power. But again, we validate when the data hall is going to be ready, when the GPUs are going to be live. It's a lot of diligence. And then moving on, as the other panelists mentioned, it's all about contracting. We try to secure penalties within the MSAs and the leases that we're signing that incentivize on-time delivery and penalize severe delays. Obviously, we don't have as much leverage as someone like Microsoft to do it with our operators, but we aspire to be like them in terms of really aligning incentives with our end customers. So if the data center operator, if the GPU cloud is delayed, they will pay a penalty, and that's simply for incentive alignment, particularly for power or long lead time equipment.
I think one important point that we've seen, the ramp time is not like it was 5 years ago. So if you're talking about 100 megawatts, you don't get 5 years anymore to ramp into that contract. So it's probably more important now to protect both sides because of the lack of ramp, if you will. If somebody is constructing 100 megawatts, let's say that's 50,000 GPUs, it's essentially on day one. There's no 3-year or 5-year, burn-in. So if you don't have the power ready and able, you're probably not going to have your contract in place.
And I think David and I, as the operators, were clamoring a bit to respond to that, because I think everyone's incentives are aligned. Everybody wants to deliver on time. No one wants to have delays. And, the contract mechanisms around penalties, et cetera, they do help. They're a stick. But the reality is that, that doesn't help the end customer. That doesn't help the operators. So, yeah, the diligence is great, but the reality is there are still lots of unpredictable risks with power delivery in constrained markets, even when the best-in-class due diligence has been done, because the regulatory landscape is changing, the utilities are unpredictable, and I think that with scale comes a need for greater discussion around how to partner on trying to mitigate those risks and allocate risk fairly, because fundamentally a massive utility delay that is completely beyond the party's control can lead to penalties now which could effectively sink, certain people within the market.
That's going to be a nice segue to the next question. But before we do, Atif, who has the data, what is the data on what percentage of projects are being delivered on time? If you have it, we didn't talk about this previously.
Absolutely. So look, my team and I at Oxford, in my academic capacity, built a data set of over 16,000 mega projects. So this includes rail, nuclear power plants, gas, including data centers. And the data center data set is around 1,000 completed data centers since early 2000s. So 9 out of 10 data centers are delayed, unfortunately. The average delay is 34%. So 18-month data centers become 24-month data centers quite routinely. And on HPCs, that overrun is closer to 50%. So I'm not a lawyer, but I'm interested in how contracts can improve incentives in order to improve that alignment. Now, a couple of observations that are helpful. First of all, the precise contract form is not a significant variable in driving that overrun. So even if you have an alliancing contract or a particular FIDIC contract, that does not turn up in our analyses as the one driving the overrun. Ultimately, it's execution capacity. So people perhaps, although the upfront diligence is really important, maybe they could reduce the amount of legal bickering and make a bigger plan around execution, and that would be a much more helpful thing. The other observation is that permits and power are highly anticipatable risk factors that people are negotiating around, and they don't tend to impact SLAs as much as they used to. But there's a death by 1,000 cuts that happens in projects, from delayed bus bars to long lead items not arriving on time to commissioning done poorly. That is where a lot of leakage is happening at the moment. And I think that's where operators could do well to insert standard clauses in the contracts with their GCs to incentivize them to deliver on time and provide the labor as well as the execution capacity to not delay. Final observation, the SLA penalties the operators have to pay are orders of magnitude greater than any liquidated damages that the contractors owe the operators. So there is some work to be done to improve incentive alignment.
I think from my perspective as the lawyer, it's kind of a funny comment to make, that I sort of comment that it's not really in some respects that relevant what's in the contract. We're focusing more on the partnerships with the GCs and the vendors that we're working with, because actually if you're getting the right peoples working with you in your supply chain, you're better able to mitigate your risk than trying to slap a load of penalties on them in the contract. Because, same as we were talking about with the customers and the operators being aligned, the GCs don't want to be late. And sticking them with bigger penalties isn't effective.
Cabral, coming to you with a direct follow-on question. We talked about power delivery risk, supply chain risk, which we'll get to in a minute, was also raised. But in the contracting world, we have this force majeure clause, which has kind of taken a life of its own, and a clause that essentially says if causes are beyond one's reasonable control, then it's an excused failure. How are force majeure clauses? Are they being used? Are they being used effectively and properly, and under what circumstances?
I'm sure you'd find some disagreement between the hyperscalers and the operators here, but I think that is something that we are seeing now, is that they are being used in an expanded way than they have been previously, and so what is deemed as beyond a person's reasonable control has started to include things that probably should have been called out in a different way within the contract. And so, and that's, I think, something that we're trying to talk about, because I do agree with you, we are aligned on the same goal, which is to get the data center open on the date that we all need it by and that it's promised by. And so using force majeure kind of as an excuse or mechanism to kind of get out of that isn't really helpful. And so I think we do need to have but more and better conversations about what's really included in there and what is not included in there, so that it brings more clarity as we move forward.
Oddly, I completely agree. And I think that's because, being honest, the force majeure clauses, as probably a lot of people know, it's super hard to get something stuck within a force majeure definition, because okay, what is really beyond someone's reasonable control? Didn't we contemplate at the point that we entered into the contract that there's, geopolitical tension in the world? And, lots of the drafting in the customer contracts around, could a best-in-class operator have mitigated this risk? Well, probably in a lot of circumstances, yes. So I don't think we're certainly never looking to use force majeure as an excusing factor. And actually, I would much rather have an honest conversation at the beginning about some of the key risks in the market at the moment, particularly around power and utility delay, and if there are permitting risks still in relation to the scheme, and clearly align between the parties, what are we saying here? It are things where there's a risk sharing to be done, and where are we saying, no, we're the developer and we stand behind this. And no one wants to be having an argument at the end. At that point, the relationship has broken down, and that's not where anyone wants to be.
I think the other thing also is the contracts now at the scale we're talking about are being shared with the funding partners as well. So you're having a whole different conversation with different people in the room. We're talking about billions of dollars the funding partners care about delivery because that's when revenue starts. So the dynamic is changing pretty significantly as the scale changes.
So I wanted to maybe follow up with you and then a slightly different angle with Ilan on the same question, where long lead item equipment, which I'm going to have two questions. This is the first one. We're here in 12 to 24 months on transformers, GPUs, PDUs, significant backlog on long lead item equipment. If you're in the midst of a build where you have delivery projections and one of the material supply inputs, say electrical transformers, you thought you were going to have them in a year and it's 18 months, force majeure, or is that risk on you? How do you contract around that?
We, again, are not really trying to look at it on sort of a force majeure angle. We're trying to mitigate risk in other ways. So with supply chain long lead items, we are focusing a lot on vendor relationships, not having one single point of failure for certain type of equipment, working really closely with our important vendors to have options, to also be an important relationship for them, so that if there are issues, we've got a relationship beyond the contractual terms to work with that vendor to secure long lead equipment. We also work a lot on, we work a large pre-buy program where we have a lot of inventory sitting there ready to go at any one point. So if there are issues, if there is damaged equipment, for example, we have a large inventory stock ready to go to replace the equipment items. So a lot of the risk mitigation we're doing is probably not on the legal terms. So again, selling myself out of a job, it's sort of with other risk mitigation strategies.
I think procurement is becoming competitive advantage. If you're planning multi-hundred megawatt sites, you need fungibility in your procurement. You also need diversity regionally. So in Australia, we're probably more exposed to India and China in a positive way rather than we're in Europe, but just being, relying on Europe. And the more we think about this very long-term planning, it's a competitive advantage to think long-term.
Ilan, similar question for you. So listen, there's no piece of equipment in shorter supply than GPUs, and you have commitments to your customers, and so you make commitments to your customers for delivery of service in a particular time period. You get a phone call, GPUs on back order, you're 6 months delayed. How does that affect your business? Do you build that in? Do you take the risk? Do your customers take the risk?
Yeah, it can definitely substantially negatively affect our business because sometimes we have on our GPU as a service contracts, we have payment penalty clauses that we have to pay if we are substantially delayed. So we try to align the start date of our contracts with when the capacity will be available. But as Alana mentioned, we try to follow a similar approach to mitigate our own supply chain. So have flexibility on when we secure the equipment, have multiple sources of supply, and so on. But really, with our GPU as a service providers, we're really trying to incentivize on-time delivery as much as possible, and really keeping an open line of communication with our customers if we think there will be a delay.
So maybe, David, starting this next question with you, we're talking about a lot of contractual risk and allocation here. Let's talk about long lead item equipment. So you kick off a project and nothing is in place on day one, and you're looking, and then you're in conversations with a Microsoft or other hyperscale tenant for delivery of this site at a time when you don't have a customer contract in place. You may not have all the permits and power agreements in place. Meanwhile, you're looking at this long lead item equipment that if you wait until all the other pieces are in place, the permits, the power contracts, the customer contract, and then you order equipment, you would never be able to meet the customer demand for timely delivery. Are you going at risk for the pre-ordering of long lead item equipment to mitigate not mitigate delays, but to say to meet delivery demand? Or are you doing other contractual arrangements to try to mitigate that risk vis-a-vis your off-takers?
The simple answer is you have to be a little bit ahead and at risk, at scale. So you want to drive a level of design that's flexible across multiple projects. For us, we try to standardize as much as possible to drive that flexibility, but being an operator that's been in business for 16 years, we've learned that you can't hold your orders back waiting for everything to align perfectly, because you're going to lose time and you have to take some risk. And it's back to everything, thematically we've been talking about. It's the entire ecosystem is partnership based. You have to have a level of trust with your supply chain, your customers, your energy providers, your funders. The earlier speaker this morning spoke about the 5-layer stack, the infrastructure stack. It is all connected. You can't just look at it in isolation and think, oh, I'll get my procurement done, could be a couple of $1 billion, and I'll wait for that. It just doesn't work anymore. The scale and the speed at which we're trying to operate, it'll backfire. So, I wouldn't say we go all in and order everything, but we have enough level of comfort that the current demand is such that we're confident enough that if we get ahead a little, it'll be okay for one of multiple projects.
I'd be interested in Cabral's take on that. So, in terms of contracting from a hyperscaler's perspective, does that cut in favor? I'll restate the fundamental point. If you're dealing with a global operator, say a CyrusOne, where you have numerous sites who can order electrical transformers, and if this project doesn't launch, it's okay, they could repurpose those transformers for site 2 or 3 or 10. Does that cut in favor of contracting with global operators with multiple locations? And if so, how do you deal with single site operators if that's their site, or regional operators? If that's their only site, it becomes increasingly difficult for them to absorb that sort of long lead item, supply chain, power, and other risk.
Yeah. I mean, I think we obviously, especially more recently, have a lot of factors that we're looking at and deciding who we work with. Some of which, most importantly, are being able to deliver capacity on a specific schedule at a specific time. And Microsoft also, we give our, operators our own design. So they do have to be able to meet that when they work with us as well. I think I wouldn't say we're limited in who we can work with. I would say that we have some flexibility there based on what they can deliver.
Great. Atif, did you have any backup data you want to add on any of these points? Or?
Look, absolutely. So just going back to the force majeure problem, so the threshold to be able to declare force majeure from a data perspective, like Alana was talking about, is much harder than you would imagine. So it's much harder to get away with force majeure than you might like as a supplier. And one of the issues that we see is the lack of visibility. So, people do quite a lot of upfront due diligence, but the contracts don't tend to stipulate information rights. So, for example, in case of operators, their contracts may not say that the contractor must make the Primavera P6 files that contain the schedule available to the operator. It may say so, but in many cases it may not. It may not stipulate that they need to provide the supply chain visibility and the process they're going through for factory acceptance tests, so factory witness tests, or site acceptance tests, etc. And with AI, if you have access to that data, even if it's quite messy, you can draw a signal very quickly of whether or not your supply chain is going to deliver you or not. But if the contract does not provide for those information rights, your supply chain will fight you tooth and nail and prevent you from having that visibility. So there's a tendency to brush a lot of sort of managerial hiccups under the carpet of force majeure, which should really be driven by better execution and better visibility of the data, and which is where I think contracts can be really helpful in requiring that information upfront, from the BIM models to the supply chain databases to the schedule databases, et cetera, from investors, hyperscalers, operators, all the way down to the supply chain.
Ilan, slightly different take on the same question. GPU chip orders probably the single most expensive input into the entire process in these massive orders. And you got to finance those things. And fundamentally, the underwriting of a financing of a GPU contract is tied to the quality of your offtake agreement. If there are significant termination rights or walkaway rights, it becomes increasingly difficult to finance a massive GPU chip order. How do you navigate that risk model?
Yeah, it is very challenging because lenders highly scrutinize the end customer contract as well as the delivery of the data center and the chips, and they all need to tie. What do we try to do? Well, we try to first get as much alignment between the end, if this is for a large customer offtake, between their contract and delivery date, and when the chips need to be ready, and when the data center needs to be ready, those need to be tightly aligned again for the purpose of incentive alignment. We of course want to build enough buffer into our contract so that there's not a penalty or termination fee for the end customer until add as much buffer time as possible there to give us the breathing room for the inevitable delays that we talked about. And we learn from the financing process to understand what lenders need. So, on previous financing, we learned how tightly those needed to be coupled, and we've incorporated that into our most recent contracts with end offtake. But it's certainly a challenge because obviously lenders have a very low threshold for risk and don't want to take any chance that a customer could cancel their contract and then the lender being off the hook for hundreds of millions of dollars that we don't have an offtake for.
I'd like to come back to Alana and Cabral on a question around limitation of liability provisions, because I view the provisions as a bit of an anachronism or a legacy where, heavily negotiated years ago, not reopened, and when we were doing 20, 30 megawatt deals, as I said, when, there's this default limitation of liability at total contract value or some other default mechanism, regardless of what it is, it's a big number now. When you were doing 20, 30 megawatt deals, total contract value rent for the term, it might have been $50 million, which is still a big number, don't get me wrong. But a $50 million liability cap, is one thing. When you're talking about $10 billion of rent being paid over the term of a gigawatt campus. Well, I've been doing this 30 years. I've never seen a $10 billion liability. I've never seen a $1 billion liability. Does the provision have any meaning, or is it just a capless cap, and these provisions need to be revisited? Cabral and we expect some crossfire action on this one.
You're going to let me go first. Okay. Well, I will say I have the perspective that there is, unlimited is unlimited, and so a cap, though, is a cap. Before I did this job, I was on the commercial side, and we did spend a lot of time talking about this, on the other side. And so, we would never give unlimited liability as Microsoft, for example. So I can kind of appreciate most people want to have a cap, but I understand the question. You're saying they're now so big, are they sort of meaningless? But I do think, for us, there is still some import to making sure that we have the right level of coverage and risk, to cover the risk in the contract that we're entering into. And I think that's both from the operator, the supplier, but, we have to look at that ourselves as well and make sure that, we, Microsoft, can cover that risk too. Because there is a point, I guess you could bank technically bankrupt possibly the operator if the number was so large.
Yeah, I think that's at the point where I agree with you, Kamal. It just becomes basically irrelevant, because at that point, what good is it if you've, someone's become insolvent off the back of it, and that you're not going to be able to claim that amount in any event. I think that one thing that I'm seeing coming more, and I think is quite important, is potentially having like different caps for different things. So where you're looking at delivery risk and the liability cap that applies there, I think I'm seeing slightly more ability to include a separate liability cap related to the SLAs and having that as a sole and exclusive remedy, other than termination. And I think that, at that point, if people have the ability to terminate, there should come an end to the pain, and just sort of sitting on something where there has been a genuinely large mistake that has been made beyond anyone's control, such as utility. And obviously, like, no one wants to be in that situation, but there are sites where these things have happened in the market. And what use is that giant liability cap going to be at that point, really? So I see it from both sides of the story, and I get the sort of need to have an adequate liability cap, but I think that there is room to have kind of slightly more nuance within it, and I agree that like the old metrics related to total contract value, when you've got giant above 200 megawatt sites, I don't really see fully how those will work. Although I think we're seeing as well sort of bundling up and splitting up of sites to mitigate that, so that you're not having like one giant contract of the whole campus. You are kind of bundling it up and splitting it up in different ways.
So from a data perspective, it's not uncommon, and I have a lot of sympathy for operators, because they're often stuck in a rock and a hard place. So it's not uncommon for a 100 megawatt data center, after a delay like the sort of delays I talked about, say 4 to 6 months, to end up having to pay $80 million worth of SLA penalties or other forms of contractual renegotiation. So they may not pay out the SLA penalty in cold hard cash, but there is some renegotiation that goes along with it. And one thing I think operators sometimes forget is that hyperscalers are publicly listed companies, and they are very large administrative machines. So even if you have a very good relationship at a commercial level, that relationship will not protect you from their bureaucracy doing its job. And it will come and you can negotiate, but it's not going to go away. So you may have an $80 million SLA penalty and a $20 million claim from your GC. So it could really hurt. Again, I hate to be reiterating this. There's no antidote apart from better execution, way more visibility around the data, and then the operators have to drive that both with their onward customers, the tenants, as well as the supply chain.
I was also going to say the theme that we're all seeing is speed. Speed. Everybody wants capacity quickly. And, at the scale we're talking about, if you want to go fast, you can't be stuck on every contract item. You'll be negotiating for 18 months, and people want capacity in 18 months. The flip side to all of this is the investment in the chips is so large that no one can afford to have 20, 30, 50,000 GPUs, in a holding pattern, not being deployed and, not being, not delivering tokens to the extent that that's what they were designed for, waiting for the agreement, to land. And I think that is something that's playing out in real time.
I'll stick with you on this one, because it's an offshoot of what we've been talking about. So when you're talking about, say, a gigawatt campus and a $10, $15 billion project that might be 4 years, 5 years in the making before delivery, but meanwhile you need to finance that up front, the construction costs, and at a time when its revenue is still years off. we have seen lenders who, I mean, you raised a very good point. There's no substitute for execution, but lenders look at the risk profile of a deal as if there were going to be execution failures, and they price their debt accordingly. The question is, we have seen a broad spectrum of contracts ranging from, if you want this to be a bankable contract, there can be no or limited termination rights for your offtake contract, to more traditional, there can be quite aggressive, termination rights for something that's going to be delivered 4 years into the future with a gigawatt at stake. How are you able to finance against that risk? Do you see the industry migrating towards fewer termination rights in offtake contracts, customer contracts, or is it still, are contracts still looking the same as they were 4 or 5 years ago?
For the more mature customers, yes, the answer is that there has to be less tolerance for that. I think the newer neo clouds that don't have the decade of history of operating, it's back to speed and deployment of capital and getting their customers up and running. Perhaps they have a little bit more flexibility in that lane. But I think we're talking about some of the gigawatt scale that's coming that isn't already operational, so it's quite difficult to speak about that specifically. We'll know more in the next couple of years. I think if we look at where we're at today, there's still the appetite to fund those projects in a significant way.
I think some people have said to me that what you're seeing in the US, you tend to see sort of 9 to 12 months later in Europe, and I don't have the stats for the Oz, I'm afraid. But I think in our US operations, we are seeing more scrutiny from the lenders. Any site that we're taking forward of scale, we're not sort of taking to chance that we're going to be able to finance the customer contract at the end of it. And we're engaging early with our investors and the lenders to make sure that we're getting the right provisions in there to put us in the best possible position where we can negotiate them. And that has included an improvement in position on termination rights.
Cabral, anything to add on this point, or?
No, I would just say, in agreeing with Alana, that we are seeing that in the U.S., that the lenders are getting quite a bit more involved, and then that tends to be passed down to us as the hyperscaler. One thing that's a blessing about Microsoft, of course, is we're one of the only AAA credit-rated companies, and so we are actually using that, in our discussions to say this should secure you, better financing and also us better contract rights. So we kind of flip it a bit to make sure we're getting the benefits of that from the financing and from the operators.
I'd like to build on that point and start with Ilan. So Microsoft is in fact one of only 2 AAA credit-rated companies on Earth, and if Microsoft is the off-taker, life becomes a lot easier on the financing side, to say the least. But we have a lot of neoclouds out there that while they're up and coming, and we expect great things from the neocloud sector, the credit ratings are just not there yet. When you purchase from a neocloud, I mean, how's that bankable? Some of our neocloud deals we'll see like a wrapper come from Microsoft or Google and come in and say, look, we'll guarantee it, or an NVIDIA on the GPU chip side. What other, are those the options? How do you bank a deal when you're doing a deal with a neocloud?
Yeah, us as a neocloud trying to get a deal done is, the financing and credit is the biggest challenge, bar none. And so the quote-unquote easy button is to sell a large GPU cluster to a hyperscaler, and their offtake or potentially credit enhancement helps solves the problem. If that isn't an option, we have to go to other third parties. And I think one conversation I'm having with several people at this conference is various people in the ecosystem, whether this is on the investor side, on the technology side, even on the data center operator side, realizing there is an emerging appetite for tokens driven by these next-gen AI companies, which companies like Together AI and people in our breed can really help service. And so there is an appetite to serve this riskier profile of customers. It's still being figured out, but this is going to come from, various private equity firms, sovereign wealth funds, sometimes technology partners with a very large and robust balance sheet who want to have their technology be part of the neocloud solution. Those are all of the various people we're engaging with to help enhance our credit when we are trying to build and deploy the data, the clusters for our end customers. But it no doubt is a huge challenge.
Cabral?
No,
I thought. So as we approach the 6-minute mark here, let's turn to. I'll couple this audience question with one of our own, and I'll start with our operators here on this one. So one of the, as we talk about sort of, I wouldn't call it a chicken or the egg situation, but one of the earliest things you need to do, as we've been talking about, to launch the development of a site is to enter into your power contracts. These are massive long-term commitments, oftentimes with upfront or relatively near-term financial obligations at a time when the project itself is still in its nascency. How do you balance this power contract risk? It's one of the first steps in the process, one of the biggest financial commitments in the process, but yet the process itself is still in its nascency.
We're a public company, so you have to figure out how you're going to raise money. And ultimately, for the last 5 to 10 years, it was all about funding. Now it's very much about power and power. I think the two are coming together. You need the funding, you need your power strategy, and you need to think very, very strategically about where you're going to invest your time and your energy on some of these bigger projects. Fortunately for an operator like us, we have an existing business that is, the day-to-day, it's generating revenue, profit, and it enables us to think about the next generation of investment and the sites that will come the next 1, 3, 5 years. I think there are new emerging players coming in, looking at this saying, I'll start now. And that's going to take 3, 5 years to get going. So we think, again, it's a competitive advantage to have access to capital and have your power planning done together.
Well, great. Well, let's try to close out with a couple of audience questions, but I did have one follow-up on the power. Maybe, again, for one of our operators, how effective are behind-the-meter solutions as a risk mitigation strategy for timely delivery in the short term, medium term, and long term? Maybe, Ilona?
I think it depends a bit which location you're talking about. And I think, just speaking for a European perspective, I think it's still pretty tricky. I think from a permitting perspective, it's a hard sell to get the permits for near-site power generation. From an ESG standpoint, for operators and end customers and for some of the capital sources, I also think it's still quite a difficult story in the European market. We've certainly seen it with more success and scale in the US, but from my perspective and experience, we're not seeing that to the same extent in the European market yet.
Oh, yeah, sure. Oh, yeah. So we are going to skip the insurance question because, or at least those who appeared on the prep call, we do not have an insurance expert on the panel, and I certainly am not one. I read past those provisions and kick it to the insurance people. But let's talk about maybe the GC risk. That's a question here, basically saying that there's so much demand and there's a limited number of GCs out there. You know, how willing are developers to relax penalties and offer more lenient contracts because they just don't have the existing GC relationship? Anybody want to take that, or
if you don't, well, at least in our region, if you're not, you know, the number one or two, this is very complicated digital infrastructure we're building, and if you don't have the credibility, you're probably going to fail. So again, it's relationships with those GCs that have got proven track record, similar to the vision with power and financing. We'll sit with GCs and talk about projects that are 3, 4, 5 years out, because we need to resource. We need humans, we need electricians, we need technicians, plumbers, engineers, and that all comes together with the GC. So it's another incredibly important part of the stack.
And I think, as David was saying about the benefit of scale from the power contract perspective, I think it is quite similar with the GC relationships. I think when you're a more established operator or player within the market with a pipeline of projects that you can partner with your supply chain and your GCs on and bring them in early and say that, you know, these are the opportunities that we're going to be having in these markets over the X number of years coming forward, and you can have those strategic conversations, I think it's a lot easier to get the right relationships on. You know, yes, maybe you will concede some of the nitty-gritty on that legal negotiation to get the right party, because actually, you know, as David said, I'd rather have the right GC working with us than I would go for like my, you know, the 7th choice on better contract terms.
And just a quick point there is you have to invest in GC upskilling as an operator, and it's a continuous skill and a partnership. So even if your GC is very experienced, data centers are moving at such a rapid technological evolution that, like, from, you know, air cooled to liquid cooled, not a lot of GCs know how to do that, or may have had a lot of experience doing it. You still have to invest a lot of time and energy up front in training. Then, of course, to David's point, you know, a cadre of electricians, plumbers, and borrow from other industries, pharma, you know, other MEP heavy industries, oil and gas. But yes, operators do have to take on the task of upskilling and supporting your GCs upfront before you sign on to the contracts.
Well, we are at time, so I'd like to say thank you to our distinguished panelists.